Welcome, everyone. Thank you for joining us today. We thought we'd offer some insights through video in addition to the letter that we typically write. We'll have Katie, who will serve as our moderator, and then Rich and I will provide some insights and perspectives on the market. So with that, I'll hand it over to Katie.
So let's dive right in. Adam, do you want to just give us an update on how the markets are doing this year so far?
Yeah, sure. So as we all know, the global economy really ground to a screeching halt this spring as COVID spread throughout the world. And that really drove one of the fastest stock market declines in the history of our country. Thankfully, we're all moving forward. The world is getting back to work, and we're all learning to live with the virus. And part of that's what's helped support stock market recovery, such that the market's about flat for the year.
Flat for the year? That probably surprises a lot of people, considering the recent headlines.
Yeah, what the market's trying to tell us is that for at least now, the worst is over. It's a little challenging sometimes to describe the process, but markets are more trying to anticipate what's about to happen than they do react to what's just happened. We go into this a little bit in sort of pictures in the letter, but basically when we look at the beginning of the year, investors were thinking something like $180 of profits per share. And then when it was clear we were going to go into shutdown, that drop, there was a drop of about $40. And so now investors are looking for about $140. What's interesting is if you look at that, the bottom for now and those profit expectations happened in mid-May, and the market bottomed 2 months before that. So the market's trying to anticipate the future. It's a little bit hard to explain that process, but it also means that oftentimes the best time to invest is when things are the scariest. The market will tend to bottom when you're at the worst part of a recession. That's kind of what we saw here. There are still a couple of ways the market could go from here, depending on what happens next. And as we look forward into 2021, who knows when recovery or what that recovery will look like. But at least that's where we are now.
So Adam, how are we planning for this then? Or what are we doing this quarter?
Yeah, that's a good question, Katie. Sometimes calamity provides clarity. And so what we did this quarter is we focused. That is, we focused the stock portfolio in 23 stocks. And we thought that was a good balance of providing diversification on one hand, but on the other hand, putting your money to work and ours into areas we thought offered the most opportunity. And we also felt like taking a little risk in bonds was prudent too. So we continued down the path of the bond investing process that we described last quarter, sticking with bonds that mature in the next few years, but willing to take on some credit or company risk where we saw fit. And what that does is it allows you to collect a little more income in your portfolio.
So from here, it's hard to say what happens next with the virus and any impact it's going to have. I suspect there's a scenario where shutdown becomes a little more common again, and we revisit some of that fear we saw. Nobody really quite knows there. I will say this, it's clear to us that the market has almost two sides in stocks or companies right now. There's the online winners in the online economy, which is really humming along, doing great, and their stock prices look as such. I mean, they're up quite a bit. And then you've got kind of everything else, which isn't doing as well. And we think that in a recovery scenario, what might happen is it might just start to go like this again. What's happened, of course, in our portfolios is the companies that we do have that have participated in the online side, they're a little more weight now in the portfolio, and we're probably looking at trying to balance that out a little bit, looking at putting a little bit more recovery type of companies in the portfolio. Slowly, and of course within our process, we're not likely to go and buy a company that we think is not a very good company. So that's really the big issue that we see in the markets right now, and really the key issue that we're focused on as investors.
By recovery company, can you give an example of something in our portfolio?
Yeah, within our portfolio, there's even, I think you can look at something like a Visa or an Ecolab. Ecolab serves restaurants. It's clear that, a company that makes cleaning and sanitization products is probably going to be in more demand at some point in the future. But right now, with the restaurant and the hotel business really struggling, and we even saw it just recently when they reported their last earnings, that there's a little bit of a demand problem there, but that business would come back probably even stronger than it is today. Wherever consumers start to spend, we think obviously a credit card company would start to participate in that as well, even though, if you look at the credit card data right now, it's basically flat year on year, which is pretty low for something that does well when online is going. But that on-premise spending still isn't very strong. So those would be two examples. There are more extreme examples that exist, like a cruise line, but that's a scary game for us because we don't think those businesses are very good.
So Adam, you said something in the letter about how a couple of days can really make a difference. And that really surprised me. Can you expand on that?
Yeah, sure, Katie. So it's a good example of why it's so important to stay invested. And as we've all lived through, the first half of the year was a pretty bumpy market. But looking at the first half of the year, overall the market was about flat. But let's say you were an investor and you sold and you missed just the 5 best days in the first half of 2020, the 5 best days of the stock market. And rather than having an account that was flat for the first half, your account would actually have lost about a third of its value. And so that's a huge difference. And so it's really interesting to think that just missing those 5 days of the first half of the year causes your account to be that much lower. And so you really have to be insanely good or lucky to pick those days, or the alternative is just to stay invested.
To keep on the path.
Stick with the plan.
Stick with the plan. Yeah, that's right, Katie. Stick with the plan.
Well, thank you both for the insights. I hope this is beneficial for everyone. This is our first video, so let us know if you have any comments or suggestions. And thanks for watching. Have a great summer.